Well, dang, guys, what's happening? Hope you guys are all doing well. My name is Jason Krutzky. It is a great pleasure to be with you all again for an impromptu FOMC announcement. You guys, yesterday, somebody in the chat was talking about Jerome Powell speaking, and I didn't realize that we had an FOMC announcement today. So I figured you got to go live for FOMC. We do it every time. So if you've never been to an office hours for FOMC, the way that it goes is we watch the reaction, the initial reaction, which we're going to get here in about 15 minutes. They're going to announce what I think is pretty much already known. We all kind of, the consensus is that they are going to pause, right? They're not going to cut rates. They're not going to raise them, but they're not going to cut them either. So they're just going to pause. But then we're going to get the presser from Jerome Powell, and I've got it loaded up, ready to rock and roll. I'll show you guys so that you can see that I'm not lying to you. It's right here. It's kind of behind me. There it is. So as soon as he goes live, we're going to feed that in, and we're going to keep an eye on the charts, but we're going to turn the groovy tunes down, and we're going to just listen to what he has to say, because what he has to say is oftentimes more important than the actual announcement of the cut or the pause or the raise. So big thank you to everybody who tuned in. I saw there were a handful of you guys like ready to go. That's the first time that's really happened. So thank you for that. I appreciate it. If anybody was here yesterday, we had a really good session yesterday. We answered some questions and got some things figured out for some folks. So I'm curious to know kind of where y'all's heads at. There are a few of you guys in here right now. I'm curious to know what y'all are thinking about what's going to happen today. Like I said, the consensus across the street from what I'm reading is just a pause. And it's like a 96% chance of that. And the chances of rate cuts do not start to appear until later on in the year, maybe after the first quarter into the second quarter. What are y'all's expectations? How are you guys playing it today? You know, obviously markets had a bit of a rough morning. You had Google yesterday. You had, what else do we have yesterday? Microsoft. And what's up? Why not? Good to see you, sir. Thank you for being here. And both reported double beats and both sold off. I'm curious to know, I haven't even like looked at how they're doing today. So let's check and see what's up there. Yeah, so you had the initial earnings. Well, no, sorry. This is the open today. Let me see if they throw this back up. Interesting. So they ran it to start the morning, then sold it off completely. What's the story on Google? Not as good of a look for Google. Just a sell-off and nothing. No buyback at all. So it's kind of interesting. We talked yesterday about how both of these names had really run up quite a bit more, about 50% more than they tend to when they run up into earnings. Historically, they had both run about 50% higher than they tend to. So, you know, that was a little bit of a nudge in the direction of perhaps we won't get quite the push higher, even if the news is good, because some of it's already priced in. And we also noted the slight weakness in seasonality going into February on both of these names. I believe that Microsoft was in a better condition seasonally than Google. Yeah, so Google 42% win rate in February versus Microsoft, which I think was like 50. Oh, 42 as well. We can also go back. I want to just take another look at this and go back just the past decade. Yeah, so this is what I was looking at. 50% win rate in February over the past 10 years on Microsoft, on Google. 50% win rate. Okay, so not so bad, but you know, clearly strong Januaries coming into some seasonal weakness. So is the sell-off a surprise? I don't know. What do you guys think? James Howard. 12 SPX SPY. What does this mean, James? 12 minutes. Got it. So, all right. So we got 12 minutes. I'm going to pull up multi-symbol view here. And I want to lean on you guys. What do you want to keep an eye on? We can keep an eye on up to 14 and a half names, because it's the one behind my head you're not going to be able to see. But we can keep an eye on a bunch of symbols while we wait here. And are there any in particular that you guys want to watch? You know, obviously, I want to throw the SPY up. I want to throw the Qs up. I want to throw the IWM up. But if there are any individual tickers, any individual names that you're particularly interested in keeping an eye on upon this announcement, leave them in the chat and let me know. Generally speaking, I'll throw up some cryptos. So I'm going to do that. We'll put up BTC here. No need to really put up anything other than Bitcoin. I feel like Bitcoin will probably tell us what we need to know. Soxel for Steve. We could do that. Here's your Soxel, sir. And these are just 1 minute charts, so I'll be adjusting them kind of as we go. Tesla's usually one that folks want to keep an eye on. I'll throw up Tesla here. Do we want to put up any like, okay, DKNG, cool. Do we want to put up any like oil names or even like oil futures maybe? Anything for like you know, kind of a wider view on what's happening. We could put up like TNX or TLT maybe. Oxy, Snow, AMD. Let's put up Snow. Oh yeah, VIX too, huh? That's a good one. Let me put VIX here. I'm going to go with VIXE, only because VIX is an index. Indexes are delayed by 15 minutes, so I don't want to be watching that one. I want to be watching something that's actually going to respond upon the announcement. Oxy. UNG, that's a good one. I think you're thinking of TNX. The only thing about TNX is, again, just like VIX, TNX is an index, which means it's delayed by 15 minutes. What's up, Kay? Ooh, a bank. That's a good idea. Maybe, how about instead of Bank of America, we use XLF and look at financials just as a whole. Is that cool, Steve? TFC. What's TFC? Truist. Are you a Southerner? Isn't this a southeastern company? So K, Truist will really kind of be covered in XLF. So if we can think of maybe some other index ETFs, I think that would be a good move. From Colorado, but you live in NC. Right on. I live in Colorado and I'm from Georgia. Ooh, gold, silver. That's a good one. DXY is not on the platform, which is such a sad thing to say. We have UUP, which we can definitely utilize. It's like the ETF version of DXY. So I'll throw that up. And Tone Loc, we got TLT right here, brother. Right here. PLTR? Let's see if I can replace something. Since we've got XLF, or rather, since we have crude, I'm going to remove Oxy. Put up PLTR. What's XRT? Is that retail? Could we look at Snow as either following IWM or following tech and replace Snow with XRT? Or could we look at Soxel and QQQ as kind of one and the same? I kind of look at that. Let's do that. Let's put XRT here because I think this is retail. Yeah. Now, the one thing that people have been watching is just the move out of these, you know, big tech and all that sort of stuff into more defensive. Watching Pharma. What's Pharma? XBI? You can't see it really, but it's there. See if I can move it behind my head. XHT. Oh, okay. XLV. Yeah, I guess XBI is like biotech, huh? I'm gonna move this up a little. I can just make my head smaller. You guys don't care what I look like. Let me do this. There you go. So what are we thinking? If we think that the that this announcement is basically priced in, well, if the consensus is that they're not going to raise rates, but they're not going to reduce rates either, they're not going to cut them. Is it priced in? Do we think that this is priced in? This is what myself and my coworker, who I exchange trade ideas with all day, this is what we've been talking about. Is it priced in or not? You would assume if the whole street believes that we're not going to get a rate cut, then you kind of got to think it is priced in, right? But I don't know. I really don't know. The markets always have a way of humbling. So, you know. Yeah, see, 95% odds, right? Exactly, Chewy. That's a really great point, right? We're pricing in a bunch of rate cuts. Do you think we're gonna get 6 or 7 rate cuts in? Are we gonna get 6 or 7 rate cuts like in the back half of the year? That seems not totally logical. It's possible, but it seems not totally logical, or like not totally responsible to think that's going to happen. Yeah, so you're looking at 48.60, huh? Any second now. So initial move lower for everything except for the dollar. Pretty much. DKNG not really budging too much. VIX touching a little bit higher. Bitcoin kind of unaffected. Oil unaffected. Gold starting to bounce a little. TLT bouncing a little. So the announcement just came out. So they're keeping rates unchanged, as everybody suspected. But the big piece here is the Jerome Powell presser. This is where things are going to get, or things can get spicy, right? There's always the initial move, and then Jerome Powell comes out and he speaks. And whatever he has to say and however he has to say it is really where things can get spicy, Tammy. And remember, we are going to be watching the press conference live here. I'm going to turn the music off. We're going to turn Jerome up. I've got him queued up, ready to go. He's right here. I promise. He's right behind me. So we're going to watch him speak here in about 28 minutes. Chewy, yeah, you did. All right, so it was you, Chewy, who mentioned this to me yesterday. I knew somebody in chat did, and I feel so dumb for not knowing that this was a thing that was coming. I usually am on top of these sorts of things. But dollar really liking the move here, or dollar really liking the decision not to raise rates and not to cut rates, and the general consensus over the last near term has been that the dollar strength equals risk asset weakness. So if you're seeing the dollar gaining, or if you're seeing the dollar have strength, then you need to be very mindful of your stocks and your stock exposure into dollar strength. So certainly interesting, and not so much of a surprise, I guess, to see that that's happening. Index is bouncing a little bit here. VIXY coming off a little bit. Strategic ambiguity. Is that what it is? Yeah, Tammy, no problem. Yeah, so it'd be really interesting to see what they end up doing here today. Because it does kind of seem like everybody was anticipating this. It doesn't seem like this is something that is a surprise. And that's where it gets tricky, right? Because you've got the lack of surprise, but you've also got the reality of, like you said, Chewy, the market is pricing in 6 or 7 rate cuts this year. And how fast can they perform those rate cuts? I really don't know. At what rate can they perform those rate cuts? You would kind of think that it would be an even, slow drip kind of process. A little cut here, a little cut there, testing the water, see if the markets can handle it. But each month that they don't do one, then it kind of makes it feel like they got to load them at the end of the year, right? Yeah, index is bouncing nicely. I mean, you know, the initial move was lower. Whether or not they'll be able to kind of regain where they kind of fell from, you have to wait and see. I think it's all about whatever Jerome says. And it's not even like what he says, it's the tone of how he says it, right? Is he going to come off as more hawkish? Is he going to come off as more dovish? What's the vibe going to be? What is he going to, you know, how's he going to respond to the questions that he gets asked? That's really what's going to really determine what happens today, how the markets end up, like really, how this news really impacts the markets. Very well could be, Tammy. I mean, I'm definitely not an expert on that, so I can't provide too much feedback in that way. But so far, UUP looks the best of everything that I'm looking at. VIXI starting to gain again. Indexes testing kind of the lows of the initial down move, particularly SPY. Hard to believe that they're going to just like really make it go off a cliff in either direction. Yet. Perhaps they'll make that decision once Jerome starts speaking, but until he starts speaking, I don't see how I don't know. Like I said, it feels like it's kind of priced in. We kind of all knew what was going to happen today. So then it really does all just boil down to Jerome, whatever he has to say. So Chewy, you've been calling this since yesterday. What is your expectation here? Curious to know what you're thinking. Where's your head at? We could spend a little bit of time if you guys want to. We could go back to just a big chart and we can kind of take a look at some stuff while we wait. Throw up some indicators here, kind of see, just kind of some basic stuff. So this could perhaps be kind of interesting. You've got point of control. So this is, or rather, volume by price anchored to the January lows. You've got a VWAP from that spot at 414.18 here on QQQ. That aligns with the middle Bollinger Band here. On the daily, that also aligns with a big kind of push out fair value gap, unfilled stuff in here. You've got those previous December highs around that spot too. If they do continue to sell off, you've got a bit of a volume shelf around 409, like anywhere in here kind of seems of interest if they do continue to sell off. Chewy, yeah, rug pull, but you're at all-time highs, basically. So how do you think about how do you think about the buy the dip trade? Where do you think about the buy the dip trade? If you want to look lower, go to the October lows. You got a VWAP and a point of control here, 391, 388, just kind of in this area. This big breakout from all these previous highs. They never really came back and tested. They sort of tested it, but they front ran it. So you kind of got a little area in here that could yield something, perhaps, if they wanted to really sell it off. Hard to believe they're going to do that, though. I don't know. Same idea on SPY. And the distribution is a lot different from those lows. You've got way more volume up here at these higher prices. That's kind of interesting. Actually, yeah. Yeah, so totally different look. You got your point of control on SPY from those October lows all the way up at 473. So you got more buyers up here at 473 than anywhere in this whole entire range, which is really kind of crazy to think about. But this is just something that we see so often. You rarely see lots of buyers at the actual lows. You usually see lots of buyers higher towards the top of the range. So if they do continue to decide, or if they decide to continue to sell the SPY off, definitely be looking, I would be looking in here somewhere for an initial, what does price do when it gets in here? I'm not saying you should like go long when it gets here, but just saying like, what does price do when it comes back into here? Because you do have a lot of volume. You've also got the previous all-time highs, just a little bit higher too. 479 could be a level of interest. 10% lower, you think? Yeah? Really? 50 bucks lower. Let's see. Yeah, Chewy, you think so? You think down 440? I mean, you know, y'all know me. I'm a price action guy. So this area is certainly enticing. Be a giant inverted head and shoulders if it ever came. But man, wow, that would have to be a pretty steep sell-off. Powell stock? There's such a thing? No way. Oh. Up 50% today? Are you serious? What is this? That is unreal. Is there actually a correlation? Is there a correlation between this and like Fed FOMC announcements? That would be kind of amazing. If that's the case. You know, I want to show you guys this really quick while we're waiting. We've added some new tools. I don't know if you guys are familiar with this, but if you're not a TrendSpider trader, you can actually access quite a bit of information that can be found on the platform. Or, well, I guess it's not quite a bit, but it's like, it's some basic stuff that can actually really help you. If you're not yet a TrendSpider trader utilizing the platform, we have these markets pages. I'm going to link y'all to these because these are pretty cool. You got trending on stock twits tickers. You got popular on Wall Street bets tickers. So like if you're looking for just stuff that's hot, we've got pre-made lists built for you. These they update in real time. So you can keep your eye here. Popular retail traders, recent 52-week highs, recent 52-week lows. So these are just kind of basic lists, again, for you to kind of gauge sentiment and that sort of thing. We've got some insider buy information. There's not a ton here, but it's a little something to kind of like wet your palate, and you scroll through these. we've recently added U.S. Congress and Senate trades to this. So if you click on this here, it brings up the U.S. Congress and Senate trading page. And here I can do things like type in Nancy Pelosi. And it's going to bring up all of her most recent trades, everything that she's in, how much she spent on the trades, her return since taking the trade. This is kind of cool that you're able to just immediately find this stuff. If you don't have a particular insider or congressperson or senator that you are interested in following, perhaps maybe you want to see if anybody's buying the stocks that you're buying, you know, who knows? So type in a ticker here and you will get an up-to-date list of all of the senators and congresspeople who have bought that particular stock. And of course you can input Tuberville. You can input like multiple things. You can input the congressperson's name and the ticker to get that. So this is a nice little piece of extra data that you can access. You don't have to have an account with TrendSpider in order to access it. It's free. It's available for everybody. So feel free to do that. And we've also added, let me see here. Hold on one second. Let me go grab it. I need to go grab it. Give me one sec. Not too terribly long ago, I did a little a lesson, we'll call it, on risk to reward and how to calculate risk to reward for your trading and how important it is. And we've just added these too. So this is, we call them trading and investing calculators. So you can utilize these for lots of different things, for just calculating your profit or loss. So how much you want to invest, how much was returned after the investment. This will give you an annualized rate of return, percentage return over the period of time that you were invested in that position. You've got a compounding calculator here, which is exactly what it sounds like, a currency conversion calculator, a position size calculator. Tell it your total account value, how much of your account you want to be risking, and it'll tell you how big of a position you are allowed to take based off of that percentage risk. And then we've got this trading risk and reward calculator. And for me, this thing is kind of the coolest piece because it's a really, really great visualization of the reality behind risk to reward. One thing that you'll hear just incessantly as you're developing your trading strategies and as you're talking with other traders, especially if you're new to the markets, there is a fallacy of belief that a great strategy is one that wins all the time or wins as much of the time as possible, has a really, really high win rate. And the reality behind that is, sure, a strategy is great if it wins all the time, but generally speaking, a strategy that wins all the time tends to have a really, really low percentage return per win. And what the risk to reward calculator is specifically built to do is to help you understand that relationship. When you make more per trade, you can afford to not win as many trades, right? Your trade idea can have a lower percentage performance or a lower win rate, a lower win percentage. And so I encourage you guys, if you have not ever thought about risk to reward, I am taking this trade at this price. I am wrong if this price gets hit, and I'm right if this price gets hit. Let's say, for example, you're trading, I don't know, you're trading whatever, NVIDIA, and you're buying NVIDIA at $600. Oops, let's remove these guys. So let's say you're trading NVIDIA at $600. Oh, come on. 625. I need to speak to the dev team about this. This is not working properly for me. Okay, let's say your profit target is $625. You're trading at 600. You're long 600. You're looking for 625, and your stop loss is, I don't know, 550. Right? This thing's going to automatically calculate the risk to reward for you. So you have a 0.5 risk to reward, which is a lousy risk to reward. You're risking 25 bucks, or you're risking 50 bucks to make 25 bucks. And sure, that makes no sense, right? And it's really easy to see that that makes no sense. But you can take this idea and push out on it, you know, like maybe you want to be long 600, maybe you want to profit your target 625. You can adjust, you can play around with the stop loss here. Maybe it needs to be like 615, or maybe it needs to be 620 or whatever, right? You can oops, let's do this, make it I don't know, 585, right? Because your entry 600. So now you've got a risk to reward that's 1.67. This requires a 43.5% win rate for consistent profitability. So as the win rate goes up, the return goes down, and vice versa. Anyway, I just want you guys to know that this is here. This is free for you guys to use. And it could be very, very helpful if you find yourself having trouble deciding where you should be getting into or out of trades, how to measure these sorts of things. Very, very helpful. Useful tool. Much recommend. Strong recommend. James, ticker request, huh? Let's take a look. How much time we got? We got 8 minutes. Let's take a look real quick. SPR? Spirit Aerosystem Holdings. You know me, I always start way out. I want to see where this thing came from. So I've got the point of, or rather the volume by price anchored to the IPO, looks like. Yeah, to the IPO. So we're just stuck between the VWAP from the IPO and the point of control from the IPO. Seems like just initially they held lows. So that's what you'd want to see. Kind of like a big long-term potential little double bottom thing forming here. The fact that they held lows is good. Here's your March, your COVID low. They were not able to push below that. So that's good to see. Let me see. Let me zoom in a little bit. You definitely have a monthly fair value gap in here too. I'm going to turn off the bullies. You got a monthly fair value gap in here that they've come back in and filled some of. I also am always going to do this. So I'm anchoring, or rather, this is just a auto fib. Or rather, not an auto fib, just a standard fib. Let's get music going again. And, you know, if they do end up holding it here, this is kind of what you want to see. This would be a really strong, like, they didn't really pull it back very much. Put the 238, and you could put the 0.382 in there too. So that's not too bad of a pullback. Looks like they bounced the 0.382. Let's jump into the weekly here. Let's go off the lows. I'm just going to anchor a VWAP to the lows. So you do have that to consider. They're front running that VWAP right now. You've got a little bit of a potential inverted head and shoulders look happening here. They were able to gain right here these previous highs. So yeah, this thing looks really good actually. Let me go to a daily. So then it's just a matter of, you know, like what you're risking and what you're expecting. They were able to hold the low in between, right? So you could, in theory, depending on your risk, depending on the amount of time you want to be in this trade, I can't tell you what's right there. But just like if you were to get in today, right now, that's how I'd be thinking about it. Thinking about it like this. You're risking off lows, right? You'd be getting out of this trade off of these if price manages to go and make a new low, and you're targeting a new high, which would be these guys. So you got a 2R on that idea. Does 2R make sense for you? If 2R makes sense for you, then cool, go for it. You could analyze it all kinds of different ways, you know? That's where things get a little tricky, because if you look at the daily, technically on the daily, so lower time frame, you're in a downtrend. I mean, technically, you have put in a lower low relative. You know, if this is your big swing, this swing here, and then this swing, and then this one. So like on the daily, then you kind of expect, because you put in a new low, you expect not to make a new high. You expect that they would fail here on a daily. Doesn't mean that they'll fail there on a monthly, you know, like they can still gain this, but it's all about your time frame, really. You could do this. Oops. So what I'm doing here is I'm measuring out the extensions just to see if there are any. Yeah, so you got the 1.236 up there at those old highs. So yeah, on the daily to me, it feels like since you've made a new low, you might have to anticipate a failure up here. Doesn't mean that they will, because look what they did here. They made a new low, and then they gained it. Initially, though, you had the failure kind of in here. So they made a new low. They came up, tested the old highs, and they failed initially, but then they run it. So I would kind of expect maybe something like this, just based off of what's happening on the monthly, because the monthly you put in a higher low, so you got to expect a new high. But on the daily, you might have a little failure up here initially. So I don't know. Harvell, well, yeah, sure, but that's not my vibe. Like I'm not a fundamental guy. I'm a technical analysis guy. But sure, by all means. You could come over here, seasonality, kind of see how it tends to perform historically. Oh, we're getting close to this meeting, y'all. Let me do something. I want to make sure that we don't miss this. Interesting, Gary. All right, so I'm going to get this music turned off here. I'm going to get old J Powell up and running. I'm going to remove myself, but I'll still be here with you. Actually, let me put myself like somewhere else. Oops. Put myself over here. Okay. Here we go. I'm going to crank up the volume so you guys can hear it. If you have any trouble hearing it, just let me know. And I'm going to go back to this view.
Good afternoon. My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. The economy has made good progress toward our dual mandate objectives. Inflation has eased from its highs without a significant increase in unemployment. That's very good news. But inflation is still too high, ongoing progress in bringing it down is not assured, and the path forward is uncertain. I want to assure the American people that we are fully committed to returning inflation to our 2% goal. Restoring price stability is essential to achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. Over the past 2 years, we have significantly tightened the stance of monetary policy. Our strong actions have moved our policy rate well into restrictive territory, and we've been seeing the effects on economic activity and inflation. As labor market tightness has eased and progress on inflation has continued, the risks to achieving our employment and inflation goals are moving into better balance. I will have more to say about monetary policy after briefly reviewing economic developments.
Can everybody hear okay?
Recent indicators suggest that economic activity has been expanding at a solid pace. GDP growth in the fourth quarter of last year came in at 3.3%. For 2023 as a whole, GDP expanded at 3.1%, bolstered by strong consumer demand as well as improving supply conditions. Activity in the housing sector was subdued over the past year, largely reflecting high mortgage rates. High interest rates also appear to have been weighing on business fixed investment. The labor market remains tight, but supply and demand conditions continue to come into better balance. Over the past 3 months, payroll job gains averaged 165,000 jobs per month, a pace that is well below that seen a year ago, but still strong. The unemployment rate remains low at 3.7%. Strong job creation has been accompanied by an increase in the supply of workers. The labor force participation rate has moved up on balance over the past year, particularly for individuals aged 25 to 54 years, and immigration has returned to pre-pandemic levels. Nominal wage growth has been easing and job vacancies have declined. Although the jobs to workers gap has narrowed, labor demand still exceeds the supply of available workers. Inflation has eased notably over the past year, but remains above our longer run goal of 2%. Total PCE prices rose 2.6% over the 12 months ending in December. Excluding the volatile food and energy categories, core PCE prices rose 2.9%. The lower inflation readings over the second half of last year are welcome, but we will need to see continuing evidence to build confidence that inflation is moving down sustainably toward our goal. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We're highly attentive to the risks that high inflation poses to both sides of our mandate, and we're strongly committed to returning inflation to our 2% objective. Over the past 2 years, we have raised our policy rate by 5.25 percentage points, and we've decreased our securities holdings by more than $1.3 trillion. Our restrictive stance of monetary policy is putting downward pressure on economic activity and inflation. The committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%, and to continue the process of significantly reducing our securities holdings. We believe that our policy rate is likely at its peak for this tightening cycle, and that if the economy evolves broadly as expected, it will likely be appropriate to begin dialing back policy restraint at some point this year. But the economy has surprised forecasters in many ways since the pandemic, and ongoing progress toward our 2% inflation objective is not assured. The economic outlook is uncertain, and we remain highly attentive to inflation risks. We are prepared to maintain the current target range for the federal funds rate for longer, if appropriate. As labor market tightness has eased and progress on inflation has continued, the risks to achieving our employment and inflation goals are moving into better balance. We know that reducing policy restraint too soon or too much could result in a reversal of the progress we've seen on inflation and ultimately require even tighter policy to get inflation back to 2%. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess the incoming data, the evolving outlook, and the balance of risks. The committee does not expect that it will be appropriate to reduce the target range until it has gained greater confidence that inflation is moving sustainably toward 2%.
That seems important.
We will continue to make our decisions meeting by meeting. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to our questions.
That's where it gets real.
Sheena Smiley from the New York Times. Thanks for taking our questions. Obviously, in the statement and just in your remarks there, you note that you don't want to cut interest rates without greater confidence that inflation is coming down fully. I wonder, what do you need to see at this point to gain that confidence? And as you make those decisions, how are you weighing recent strong growth in consumer spending data against the sort of solid inflation progress you've been seeing?
Sorry, say that last part again.
How are you weighing the growth data and consumption data, which have been surprisingly strong, against inflation data?
Okay. So what are we looking for to get greater confidence? Let me say that we have confidence. We're looking for greater confidence that inflation is moving sustainably down to 2%. Implicitly, we do have confidence and has been increasing, but we want to get greater confidence. What do we want to see? We want to see more good data. It's not that we're looking for better data. We're looking at continuation of the good data that we've been seeing. And a good example is inflation. So we have 6 months of good inflation data. The question really is, that 6 months of good inflation data, is it sending us a true signal that we are in fact on a path, sustainable path down to 2% inflation? That's the question. And the answer will come from some more data that's also good data. It's not that the 6 month data isn't low enough. It is. It's just a question of, can we take that with confidence that we're moving sustainably down to 2%? That's really what we're thinking about. In terms of growth, we've had strong growth. I mean, if you take a step back, we've had strong growth, very strong growth last year, going right into the fourth quarter. And yet we've had a very strong labor market, and we've had inflation coming down. So I think, whereas a year ago we were thinking that we needed to see some softening in economic activity, that hasn't been the case. So I think we look at stronger growth. We don't look at it as a problem. I think at this point we want to see strong growth. We want to see a strong labor market. We're not looking for a weaker labor market. We're looking for inflation to continue to come down as it has been coming down for the last 6 months.
And I'm sorry, if I could just follow up very quickly. When you say that you want to make sure that it's a true signal, is there anything that you're seeing in the data that makes you doubt that it's a true signal at this stage?
No, I think I would say it seems to be the likely case that we will achieve that confidence, but we have to achieve it, and we haven't yet. And so, I mean, it's a good story. We have 6 months of good inflation, but you can, and you know this, you can look behind those numbers and you can see that a lot of it's been coming from goods inflation, for example, and goods inflation running significantly negative. It's a reasonable assumption that over time, goods inflation will flatten out, probably approximate zero. That would mean the services sectors would have to contribute more. So, in other words, what we care about is the aggregate number, not so much the composition, but we just need to see more. That's where we are as a committee. We need to see more evidence that sort of confirms what we think we're seeing and that tells us that we are on, gives us confidence that we're on a path to a sustainable path down to 2% inflation.
Nick Timmeros of the Wall Street Journal. Chair Powell, it seems to me you raised rates rapidly over the last 2 years for two reasons. One was the risk of a wage price spiral. Two, there were risks of inflation expectations becoming unanchored. This morning's ECI report for the fourth quarter shows private sector payroll growth running at a sub 4% pace. Inflation expectations are very close to where they were before the inflation emergency of the last 3 years. And given that you appear to have substantially cut off these two tail risks, and that you've judged here today current policy is well into restrictive territory, what good reason is there to keep policy rates above 5%? Are you really going to learn more waiting 6 weeks versus 3 months from now that you have avoided those two risks?
So, as you know, almost every participant on the committee does believe that it will be appropriate to reduce rates. And for partly for the reasons that you say, you know, we feel like inflation is coming down. Growth has been strong. The labor market is strong. What we're trying to do is identify a place where we're really confident about inflation getting back down to 2%, so that we can then begin the process of dialing back the restrictive level. So overall, I think people do believe, and as you know, the median participant wrote down 3 rate cuts this year. But I think to get to that place where we feel comfortable starting the process, we need some confirmation that inflation is in fact coming down sustainably to 2%.
If I could ask differently, if you hold rates high as inflation moderates, as it has been, target rates will exceed the prescriptions of the Taylor rule or its variants. What would be the reasoning for holding rates higher than the levels recommended by those rules in the current instance?
Well, look, I think, as you know, we consult a range of Taylor rules and non-Taylor kind of rules. We consult them regularly. They're in our Teal book, and they're in all the materials that we look at. But, you know, I don't think we've ever been at a place where we were setting policy by them. And they're, depending on the rule, it will tell you different things. There are many different formulations. Another way to think about it is implicitly is so. In theory, of course, real rates go up if holding all else equal as inflation comes down. But that doesn't mean we can mechanically adjust policy as real rates, as inflation comes down. It doesn't mean that at all, because for one thing, we don't know. We look at more than just the Fed funds rate. We look at broadly financial conditions. But in addition, we don't know with great confidence where the neutral rate of interest is at any given time. But that also doesn't mean that we wait around to see the economy turn down, because that will be too late. So we're really in a risk management mode of managing the risk, as I mentioned in my opening remarks, managing the risk that we move too soon and move too late. And I think to move, which is where almost everyone on the committee is in favor of moving rates down this year. But the timing of that is going to be linked to our gaining confidence that inflation is on a sustainable path down to 2%.
Howard.
Hi, thanks, Chair Bell. I'd like you to key in on the use of the word in the statement that inflation still remains elevated. You've pledged to cut rates before inflation reached 2%. So that implies that there's some sort of intermediate step here on inflation, and that a cut would be consequent with a change in the statement language that inflation remains elevated. What's the step down from there?
Yeah, I don't know that we've worked out the particular statement language and that kind of thing. I would just say, if you look at where 12-month inflation is, and it's it's still well above core is 2.9%, for example, 12 months, which is way down from where it was. Very, very positive development, very fast decline, and the case is likely that it will continue to come down. So that's where it is. But we're wanting to see more data.
So if I could follow up on that, the statement allows that you want greater confidence on inflation falling before you cut, but it doesn't mention the other side of the mandate, a slide in employment. Would a slide in employment also bring you to the point of cutting rates?
Yes. So let me say that we're not looking for that. It's not something we're looking for. But yes, if you think about, in the base case, the economy is performing well, the labor market remains strong. If we saw an unexpected weakening certainly in the labor market, that would certainly weigh on cutting sooner. Absolutely. And if we saw inflation being stickier or higher or those sorts of things, would argue for moving later. In the base case, though, where the economy is healthy and we have ongoing growth, solid growth, we have a strong labor market, we have inflation coming down. That's what people are writing their SEP around. And in that case, what we're saying is, based on that, we think we can and should take advantage of that and be careful as we approach that question of when to begin to dial back restriction.
Claire Jones, Financial Times. Just to circle back to the greater confidence aspect of the statement, there's been a lot of unanimity in recent meetings. I'm just wondering, going forward, when it comes to all needing greater confidence, is the unanimity, or at least consensus among FOMC members, about what the threshold for that greater confidence is? And if not, could you maybe tell us a little bit about the discussion today on, what the variations between FOMC members was on what constitutes enough confidence to cut rates, and also if there was any variation on how quickly that greater confidence threshold could be reached? Thank you.
We're not really at that stage. There was no proposal to cut rates. Some people did talk about their view of the rate path. I would point you to the SEP as good evidence of where people are, although it is one cycle later. So, we're not at a place of really working out those kinds of details because we weren't actively considering moving the federal funds rate down. I will say there is a wide disparity, a healthy disparity of views, and you see that in public statements, in the minutes and the transcripts when they're released every 5 years. So we do have a healthy set of differences, and I think that's actually essential for making good policy. We're also able to reach agreement generally because we listen to each other, we compromise, and even though not everybody loves what we do, they're able to, for the most part, able to join in. To me, that's a well-functioning public institution.
Rachel.
Hi, Chair Powell, Rachel Siegel from the Washington Post. Thanks for taking our questions. So over the past few years, there have been all these real-time indicators that helped us gain a sharper understanding of where the economy was, like open table data or office attendance. You've talked about vacancies in the past. And I'm wondering at the start of this year, what might be on that dashboard for you that's giving you the clearest picture of the economy, including on rents, if you could touch on that.
Including?
Rent costs.
Yeah. Well, so we're not, it's not the pandemic, so we can actually rely on more traditional forms. People are working, they're getting wages, and the economy is largely reopened and is broadly normalizing, as you see. So I wouldn't say we're looking at that sort of more innovative data as much. You point to rents. So, of course, we follow the components of inflation very carefully, which would be goods inflation. I talked about that a little bit. You mentioned housing inflation. So the question is, when will these lower market rents find their way into measured rents as measured in PCE inflation? And we think that's coming, and we know it's coming. It's just a question of when and how big it'll be. So that's in everyone's forecast, I would say. So that will help. But at the same time, we think goods inflation will probably, it's been giving a lot of disinflation to the effort, and probably that declines over time, but it may well have some more time to run. The supply chains are not perfectly back to where they were. In addition, it takes time for the healing process to get into prices. So there may be still a tailwind. We'll find out with that. So we look at the things that relate to our mandate very carefully, and as you would imagine.
I guess just as a quick follow-up, do you feel comfortable at this point saying the economy has reached a soft landing, or is that part of looking for more confidence?
No, I wouldn't say we've achieved that, and I think we have a ways to go. Inflation is still, core inflation is still well above target on a 12-month basis. 12 months is our target. Certainly, I'm encouraged, and we're encouraged by the progress, but we're not declaring victory at all at this point. We think we have a ways to go.
Steve.
Thank you, Mr. Chairman. You've said that you would know the neutral rate by its works. So I'm wondering what you could tell me. How do you believe the neutral rate is working? We're telling you right now that growth is stronger. In other words, how much is the economy really being restrained right now by the current funds rate? And how much restraint does it really need additionally if inflation is still coming down?
So I think you do see in the interest sensitive parts of the economy, you do see, for example, housing, you see the effects, you do. Your second question, though, really, I think is important, and that is a lot of this has come through, a lot of the disinflationary process has come through the healing of supply chains and also of the labor market. So you've seen that other set of factors is really different from other cycles and has brought that working with tighter policy, which has enabled the supply side to recover, I think is that mixture has been behind what has enabled this. So no, we really do think that we're having an effect broadly across the economy. I would point to the interest sensitive parts of the economy as well as spending generally. But it's a joint story. It's a complicated story.
But how much restraint are you actually imparting to the economy, would you say, relative to the neutral rate?
So I think it's of course, that it's not something you can identify with any precision, but a standard approach would be to take the nominal rate, 5.3%, let's say, and subtract a sort of a forward measure of inflation. If you do that, and there are many, many ways to calculate the neutral rate, but that's one I like to do. And you're going to get to something that is materially above mainstream estimates of neutrality, of the neutral rate. You will, but at the same time, you look at the economy and you say, this is an economy that grew 3.1% last year. And you say, what does that tell you about the neutral rate? What's happening, though, is the supply side has been recovering in the middle of this. So that won't go on forever. So a lot of the growth we're seeing it isn't just a tug of war between interest rates and demand. You're getting, more activity because of labor market healing and supply chains healing. So I think the question is, when that peters out, I think the restriction will show up probably more sharply.
Rich.
Thank you. Sorry. Thanks for taking the question, Mr. Chairman. You mentioned earlier we're not seeking a weaker labor market. I think you said. Can you talk a little bit more about that? Do you think the labor market now is back to quote unquote normal, and that we can achieve the inflation target without wage gains coming back down to what they were pre-pandemic? Even with today's ECI levels, they were still above those pre-pandemic levels.
I think the labor market by many measures is at or nearing normal, but not totally back to normal. And you pointed to one or more of them. So I think, job openings are not quite back to where they were. Wage increases rather are not quite back to where they would need to be in the longer run. I would look at it this way, though. The economy is broadly normalizing, and so is the labor market. And that process will probably take some time. So wage setting is something that happens. It's probably will take a couple of years to get all the way back, and that's okay. That's okay. But we do see. You saw today's ECI reading. The evidence is that that wage increases are still at a healthy level, very healthy level, but they're gradually moving back to levels that would be more associated, given assumptions about productivity, are more typically associated with 2% inflation. It's an ongoing process, a healthy one, and I think we're moving in the right direction.
So that process can continue without a weakening of the labor market, basically, you're saying.
Well, I think the labor market is, I don't know if it's rebalancing. Clearly, there was a fairly severe imbalance between demand for workers and supply at the beginning of the pandemic. So we lost several million workers at the beginning of the pandemic from people dropping out of the labor force. And then when the economy reopened, you remember 2021, you had a severe labor shortage, and it was everywhere. Panic on the part of businesses, couldn't find people. So what's happened is we expected the labor market to come back quickly, and it didn't. And 2022 was a disappointing year. And, we were kind of thinking, well, maybe we won't get it back. And then 2023, we did, as you know. So labor force participation came back strongly in 23, and so did immigration. Immigration came to a halt during the pandemic. So those two forces have significantly lowered the temperature in the labor market to what is still a very strong labor market. It's still a good labor market for wages and for finding a job, but it's getting back into balance. And that's what we want to see. And one great way to look at that is what's happening with wage increases. And you see it now across the major things that we track. It isn't every quarter, but overall, there's a clear trend, still at high levels, but back down to what would be consistent with where we were before the pandemic and with 2% inflation.
Chris.
Hi, Chris Rugaber at Associated Press. Thank you. I wanted to follow up on Rich's question. It sounded like you suggested that you're not worried about faster growth so much. So wanted to see if you're seeing anything that suggests that inflation could reaccelerate from here. And it sounds like you're saying you're not worried that solid growth from here on out poses any risk to inflation. Thank you.
No, I think that is a risk, the risk that inflation would reaccelerate. I think the greater risk is that it would stabilize at a level meaningfully above 2%. That's to me more likely. Of course, if inflation were to surprise by moving back up, we would have to respond to that, and that would be a surprise at this point. But I have to tell you, that's why we keep our options open here and why we're not rushing. So I think both of those are risks, but I think the more likely risk is the one that I mentioned, which is you've had 6 good months, very good months, but what's really going to shake out here? When we look back, what will we see? Will inflation have dipped and then come back up? Are the last 6 months flattered by factors that are one-off factors that won't repeat themselves? We don't think so. We don't. That's not what we think. But that's the question we are asking. We have to ask, and we want to get comfort on that.
And just one quick follow-up. Governor Waller had mentioned the revisions that are coming on February 9th for the CPI data. Is that something you're watching as well? And if we see those revisions fairly minor, is that going to give you more confidence where things are going?
We'll just have to see. We'll look at those. Last year was a surprise.
Michael McKee, Bloomberg Radio and Television. If you don't want to use the term soft landing, would you say at least that from your point of view now, the other scenario of a hard landing caused by the Fed is off the table, or the risks have diminished very much? And you mentioned below 2% inflation on a 3-month basis. Core PCE has been running at 1.5%. And there are those on Wall Street who think that if you maintain the level of restriction you have right now, you could end up with inflation running below your target. How do you see that?
So your first question, how to describe where we are. So I guess I would just say this. Executive summary would be that growth is solid to strong over the course of last year. The labor market, 3.7% unemployment indicates that the labor market is strong. We've had just about 2 years now of unemployment under 4%. That hasn't happened in 50 years. So it's a good labor market. And we've seen inflation come down. We've talked about that. So we've got 6 months of good inflation data and an expectation that there's more to come. So this is a good situation. Let's be honest. This is a good economy. But what's the outlook? That's looking in the review. The outlook, we do expect growth to moderate. Of course, we have expected it for some time, and it hasn't happened. but we do expect that it will moderate as supply chain and labor market normalization runs its course. The labor market is rebalancing, as I mentioned. Job creation has slowed. The base of job growth has narrowed. And of course, 12-month inflation is above target and getting down closer to target. It's not guaranteed, but we do seem to be getting on track for that. So those are the risks and questions we have to answer. But overall, this is a pretty good picture. It is a good picture. Your second question was, sorry.
Could you get inflation that is below target, end up with inflation below target, and you have to do something about that?
So the thing is, we're not looking for inflation to tap the 2% base once. We're looking for it to settle out over time at 2%. And the same thing is true. If we have a month or two of lower, and we have that now, of inflation that's annualized at a lower level, that wouldn't be good. We're not looking to have inflation anchor below 2%. We're looking to have it anchor at 2%. So if we do face those circumstances, then we'll have to deal with that. I think as of now, the question we want to take advantage of this situation and finish the job on inflation while keeping the labor market strong.
Edward.
Edward Lawrence from Fox Business. Thank you, Mr. Chairman, for taking this. So as I've heard from some district Fed presidents, is it, in your view, a little premature to think that rate cuts are right around the corner? And then when we do see that first rate cut, should we interpret that as the beginning of a rate cut cycle, or is it a one-off?
So I'll point to that language on your first question. We include a statement to signal clearly that with strong growth, strong labor market, inflation coming down, the committee intends to move carefully as we consider when to begin to dial back the restrictive stance that we have in place. So if you take that to the current context, we're going to be data dependent. We're going to be looking at this meeting by meeting. Based on the meeting today, I would tell you that I don't think it's likely that the committee will reach a level of confidence by the time of the March meeting to identify March as the time to do that. But that's to be seen. So I wouldn't call, when you ask me about in the near term, I'm hearing that as March. I would say I don't think it's probably not the most likely case or what we would call the base case. Then your second question is
is this the start of when we see a cut, is it the start of a cutting cycle, or could it just be a one-off?
That's going to depend on the data. The whole thing is this is going to depend on the data. We're going to be looking at the economic data as it affects the outlook and the balance of risks, and we're going to make our decisions based on that. And it could wind up, we'll have another SEP at the March meeting, and people will write down what they think. But in the end, it's really going to depend on how the economy evolves. We talked about there are risks that would cause us to go slower. For example, stronger inflation, more persistent inflation. There are risks that would cause us to, or if they happened, that would cause us to go faster and sooner, and that would be a weakening in the labor market, or for that matter, very, very persuasive lower inflation. Those are the kinds of things. So we're just going to be reacting to the data. That's really the only way we can do this.
Victoria.
Hi, Victoria Guido with Politico. Could you talk a little bit more about productivity growth? You've mentioned multiple times about, the level of wage growth that's consistent with 2% inflation. We've obviously seen, you were talking about ECI this morning, in which it's cooled a little bit, but still sort of above what you wanted to see. Growth has been very strong. How much of those numbers do you attribute to productivity? And do you see that productivity as sort of just temporary because of the factors, the labor and supply chain factors you were talking about, or do you think that productivity growth will fade over time?
So this is a really interesting question, and I think my own view is, I think if you look back to the pandemic, you saw a spike in productivity as workers were laid off and activity didn't decline as fast. And then you saw a deep trough of productivity. And then over the last, you saw high productivity last year in 23. I think we're basically in the throes of getting through the pandemic economy. And the question will be, what is it that has changed? The productivity tends to be based on, fundamental aspects of our economy. Is there a case, will it be the case that we come out of this more productive, more on a sustained basis? And I don't know. What would it take? It would take, people talk about AI, but my guess is that we may shake out and be back where we were, because I'm not sure I see work from home doesn't seem like it's a big productivity increaser. AI, artificial intelligence, generative may be, but probably not in the short run, probably maybe in the longer run. So I'm not seeing why it would, but right now, I would say the productivity is kind of what falls out of the broader forces that are driving people in and out of the labor force, and activity returning and supply chains getting fixed.
Right. So would that be behind why we've seen such strong growth, but we've also seen inflation fall, that maybe there's just a higher level of productivity?
That's one way to look at it. Yeah.
Nancy.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. I want to ask a little bit more about housing. I'm wondering, how closely are you watching rent and housing prices as you evaluate whether and when to cut rates? And it seems like housing prices are not coming down as quickly as you expected.
So when we think about, our statutory goals are maximum employment and price stability, and that's what we're targeting. We're not targeting housing price inflation, the cost of housing, or any of those things. Those are very important things for people's lives, but they're not, those are not the things we're targeting. We're also well aware that when we cut rates at the beginning of the pandemic, for example, the housing industry was helped more than any other industry. And when we raise rates, the housing industry can be hurt because it's a very interest-sensitive sector. On top of that, we have longer run problems with the availability of housing. We have a built-up set of cities, and people are moving further and further out. So there hasn't been enough housing built, and these are not things that we have any tools to address. But where it comes into play very specifically in our work is inflation, which is a combination. It's really rental inflation. You're taking owner's equivalent rent and then actual rent paid by tenants, and you're running that through the CPI calculation or the PCE calculation, the one we look at. And what that's telling you is that market rents are increasing at a much lower rate, or even being flat, and that will show up in inflation over time. It has to, as long as that remains the case. So.
And just real quick, what is your response to the letter that was sent to you by some members of Congress asking the Fed to lower interest rates to make housing more affordable?
My response is what I started with, which is that our job, the job Congress has given us, is price stability and maximum employment. Price stability is absolutely essential for people's lives, most importantly mostly for people at the lower end of the income spectrum who are living at the edges, at the margins. And so for someone like that, high inflation in the necessities of life, right away you're in trouble. Whereas even middle class people have some scope to absorb higher costs. So we have to it's our job. It's what society has asked us to do, is to get inflation down. And the tools that we use to do it are interest rates. So that's how we think about that.
Courtney.
Courtney Brown from Axios. Can you give us some insight into whether the committee discussed the possibility of slowing balance sheet runoff in the months ahead?
Yes. So I would start by saying that balance sheet runoff so far has gone very well. And as the process has continued, we're getting to that time where questions are beginning to come into greater focus about the pace of runoff and all that. So at this meeting, we did have some discussion of the balance sheet, and we're planning to begin in-depth discussions of balance sheet issues at our next meeting in March. So those questions are all coming into scope now, and we're focusing on them, but we're at the beginning of that process, I would say.
Quick follow-up. Is it the case that the Fed would decide to lower rates and make adjustments to the balance sheet runoff in tandem?
Yes, we do. We see those as independent tools. And so they don't, for example, if you're normalizing policy, you might be reducing rates, but continuing to run off the balance sheet. In both cases, that's normalization. But from a strict monetary policy standpoint, you could say we're loosening and one with tightening. So that could happen. It's not something we're planning or thinking about, but right now we're thinking about getting to a place where we're going to see the balance sheet runoff to continue. We're watching it carefully, and as I said, we'll be looking into that as a committee starting in March.
Thanks.
Simon Urbanovich with The Economist. Thank you, Chair Powell. You've mentioned 6 good months of inflation data, but that not being enough to build up confidence. Based on your previous response that your base case is you probably wouldn't start easing yet in March, the implication is that 8 good months might not be enough either. Roughly how many months do you think you might need of good inflation data to be confident?
Yeah, I'm not in a position to put a number on it. I'm just going to say, it's not that we don't have any confidence. We have growing confidence, but not to the point where we feel like it's a highly consequential decision to start the process of dialing back on restriction, and we want to get that right. And we feel like the strong economy, strong labor market, inflation coming down, it gives us the ability to do that. We think that's the best way we can serve the public, because ultimately we've made a lot of progress on inflation. We just want to make sure that we do get the job done in a sustainable way. That's how we're thinking about it. In terms of when that'll be, that'll all come out of our communications, and we won't keep that a secret.
Hi, Chair Powell. Evan Reiser with M&I Market News. Can you explain a little bit more on what you're considering when tapering QT? Do you need to see the overnight reverse repo facility all the way down to 0, or is it something that you can start with a couple $100 billion there?
Not a decision that we've made, but I wouldn't think we wouldn't be taking a position that it's got to go to 0. I mean, if it were to stabilize at a different level, but that's not a decision that we've made. That's what we'll be talking about at the March meeting. A whole range of issues will be briefed up in the committee. We'll get into all of the issues that will be arising over the course of the next, let's say, year or so.
Greg.
Thanks, Greg Robb from Market Watch. Chair Powell, I want to change gears a little bit. In the presidential primary campaign that's been going on for the last 9 months or so, your name has come up often, and many Republican candidates had said that they probably wouldn't want to give you a 3rd term. So I wanted to give you a chance to talk about that. Do you want another term? You've had on the Fed. What's your stance on that?
I don't have a stance on that. It's not something I'm focused on. Focused on doing our jobs. This year is going to be a highly consequential year for the Fed and for monetary policy, and we're all of us very buckled down, focused on doing our jobs.
Jennifer.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. As you mentioned, core PCE has been running at 1.9% over the past 6 months. And you guys are actually expecting core inflation higher this year at 2.4% compared to that 6-month measure. Given that forecast and that the median is for 3 rate cuts this year, what happens if inflation stays where it's been over the last 6 months for the next 6 months?
So we'll update our inflation forecasts at the next meeting. You referred to the December meeting. That's 3 months old, so it might be lower now given the data we've gotten. So look, as I mentioned, we're going to be reacting to the data. If we get very strong inflation data and it kicks back up, then we'll go slower or later or both. If we got really good inflation data soon, that would matter for both that would tell us that we could go sooner and perhaps go faster. So we're just going to be but of course we'll weigh that with all the other factors. We're setting policy based on the totality of the data.
But just to follow, if inflation stays where it is currently, that would probably mean that the real interest rate becomes more restrictive. Would that mean you'd have to trim more, perhaps, than you already have factored in?
Well, I think if we came to the view that that inflation that the 6-month inflation numbers, which are very close to 2, were in PCE world, if we came to if we thought that is really where we're going to be, then yes, our policy would be in a different place. It would. But that's the whole point, is we're trying to get comfortable and gain confidence that inflation is on a sustainable path down to 2% or toward 2%.
Daniel.
Hi, Chair Powell. Daniel Avis, Agence France Presse. I just wondered if I could get your comment on the recent consumer confidence data. It seems to suggest that consumers are sort of moving towards a much more optimistic view of the economy. I just wonder, is it fair to say that they're moving towards where the Fed appears to have been in recent months? And do you think that inflation and falling inflation perhaps has played a role in that? And what challenges do you see going forward? Thank you.
Yeah, so it's been interesting that confidence surveys have been weak at a time when unemployment has been low, very low, historically low for a couple of years. But nonetheless, that's been the case. And we've asked ourselves why that is. And one obvious answer, we don't pretend to have perfect wisdom on this, but one obvious answer is that the price level is high. So prices went up much more than 2% per year for a couple of years. And people are going to the store and they're paying much more for the basics of life than they were 2 years ago, 3 years ago, and they're not happy about it. And it's fine that inflation's coming down, but the prices they're paying are still high. So that is what that has to be some part of why people are unhappy, and they're right to be unhappy. This is why we need to keep price stability. It's why we need to do our jobs, is so that people don't have to deal with things like this. In terms of you're right. In recent surveys, you've seen a couple of significant increases in consumer confidence or happiness with the economy. I guess that's a good thing. That can support spending, can support economic activity. There's some evidence of that. But it is a fact that we have seen a meaningful increase. I think levels of confidence are still maybe not as high as they've been at various times, but they certainly have come up.
Thank you for taking our questions. Brian Manasian in business. Committee members have said they'd like to meet with business leaders and stakeholders in person to learn more about the economy in real time, given that some data are subject to large revisions, the issue of seasonal adjustments being thrown off balance, and many readings of the economy being quarterly. So did any members say they've learned anything not yet reflected in the data, or have you yourself learned anything through anecdotal evidence that hasn't been captured in the data yet?
Well, yes. I'm a big believer that yes. So we do meet with outside groups who come from all different parts of the economy. And I always feel like I spent most of my life in the private sector looking at individual management teams, and then building out from that. And so starting with GDP data and working into what's actually affecting people's lives is challenging. It's very hard. So I really like anecdotal data. In addition, as you know, the 12 reserve banks have really the best network of anyone, that in all their districts, they're talking to, not just the business community, but the educational, medical, all nonprofit community. They have arms into all of that. And so when they come back, that's what goes into the beige book. But that they come back, and what each reserve bank president does is during the Outlook go around, they'll say, in my district, and they'll talk about 100 conversations. They won't talk up. They will give you input based on 100 conversations that they've had with people of all different walks. And I personally find it very helpful in understanding what's going on. And also, I think you hear things before they show up in the data sometimes.
Did any of them notice slowing economy based on what they've heard from their district?
Yes, I mean, if you look back at the last, not this beige book, but the one before, there was a lot of slower activity. I think that what you're hearing now is things are picking up a bit. You're hearing not in every district, and not every person that we talk to, but you're overall, it feels like you're hearing things picking up at the margin. So that's what comes through.
Go to Jeff Cox for the last question.
Thank you, sir. Jeff Cox from CNBC.com. Just kind of looking to put it all together. You talked about basically the economy looking strong with 3.3% annualized growth in the fourth quarter. Does the strength of the economy speak more loudly to you now than any inflation threat might? That you're in a position, in other words, to keep rates elevated as long as the economy stays strong, and you're more tilted towards that. And then also, perhaps, are you worried at all that the economy is maybe a little too strong right now, and that inflation could come back at some point?
I'm not so worried about that. It's again, we've had inflation come down without a slow economy and without important increases in unemployment, and there's no reason why we should want to get in the way of that process if it's going to continue. So, I think declining inflation, continued declines in inflation, are really the main thing we're looking at. Of course, we want the labor market to remain strong too. We don't have a growth mandate. We've got a maximum employment mandate and a price stability mandate, and those are the two things we look at. Growth only matters to the extent it influences our achievement of those two mandates. Thank you very much.
Well, guys, that's that, I suppose. I am going to get out of here. It has been such a pleasure hanging out with you guys. Hopefully you learned a lot from Jerome Powell and his expectations for the future of our economy. I am going to be back, though, tomorrow. We are going to be live for all of the earnings that are happening tomorrow. We got Apple tomorrow. We've got Meta tomorrow. We've got Amazon tomorrow. It is a huge day in the markets. 3/7 of the Mag 7 reporting tomorrow. So we're going to be live for it starting at 3:30 p.m. Eastern time. If y'all want to come hang out with me, I'd love it. If you have enjoyed hanging out today, hit the like button, subscribe to the channel if you don't already subscribe to the channel. We would be honored if you followed us. Turn on the notifications so that you guys know every time we're doing another office hours. If you don't know, if you're just here for the first time, office hours, we celebrate TrendSpider, the platform. We talk about different tools that are available on it. You guys can ask questions about anything you want related to TrendSpider, whether it be technical analysis questions. I could help you build strategies. We could do whatever you guys want to. This show is all about y'all. So if you're enjoying it, give us a like, give us a subscribe, and we will see you again tomorrow afternoon, 3:30 p.m. Eastern time for Amazon, Apple, and Meta earnings. Have a great rest of your day. And yeah, take care. We'll see you guys tomorrow.